we are meeting on virtually is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many First Nations, Inuit, and Métis people. We acknowledge, importantly, that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. And we acknowledge and honor those who've come here involuntarily, particularly those who are descendants of enslavement. Our regular ULI Toronto audience will know, and we know that many people on this call may be new to our audience, that we produced a report last year answering the call to Action 92, a guide to truth and reconciliation and corporate responsibility for the land and development sector, the Canada's first guide oriented at our industry. Years in the making, this report, though, was just a milestone in our journey to truth and reconciliation, and a journey that we hope and invite you to all join us and keep watching this spot, because a lot is coming with respect to our work in the truth and reconciliation. And you'll see in the chat how you can access that report. Today's event and the impact of ULI Toronto's programming throughout the year would not be possible without the leadership and commitment of our annual sponsors. Their support enables us to convene across sectors, elevate best practices, and foster informed dialogue on the most pressing land use challenges facing our region. This is more than sponsorship. It's a partnership rooted in shared purpose. Together, we are able to deliver thoughtful programming, credible research, and meaningful opportunities for engagement across our 2,000-member network. On behalf of ULI Toronto staff and leadership, we want to thank these companies for their continued confidence in our mission. Your partnership underpins everything we do. It's now my great pleasure to pivot to our partner, Social Capital Partners, who really are our partners in this program, and have driven the content that you're about to enjoy. Nonprofit housing providers are among Canada's strongest engines of long-term affordability, yet policies meant to protect public investment often constrain their ability to scale. Today's session explores how financing, land, and accounting frameworks can be rethought, unlock nonprofit balance sheets, and what it would take for government to shift from control to capacity. And it's exciting for us. We talk about ULI, and next slide, if you could, as being an organization that brings together private sector and public sector, but increasingly that includes now the not-for-profit sector. And so it's great pleasure to now invite Matthew Mendelson, CEO of Social Capital Partners, who's going to briefly sort of frame up what you're going to see and introduce our moderator and our presenter. And I'll be back somewhere around 1:45 to help facilitate audience questions that will come from this program. Matthew, over to you.
Thank you so much, Richard. Thank you, Alexandra. Thanks to the ULI for partnering with us on this and bringing our work to your audience and your partners. I'm just going to take 1 minute and say that at Social Capital Partners, at this moment in Canada's history, we are really focused on the question of how we can mobilize capital, deploy capital, catalyze capital. It's part of a broad national conversation, but we are particularly focused on how that can be done in ways that deliver public benefit, public purpose, community impact, environmental impact. And one of the questions is how we use public land, real estate that is in public or community or municipal hands. And we had been speaking to a lot of our partners over the last year, including Sav, who I'll introduce in a second, about some of the challenges in leveraging the equity that exists in the nonprofit sector to acquire new land, new properties, to make new investments. And so we started exploring that. We don't think we have all of the answers quite yet, but we're really interested in a policy and program conversation about how we can better leverage the equity and the ownership that exists in not-for-profits, in communities, in governments, in public hands for public benefit. So that's what we're going to be talking about today. I'll just briefly let you know that today we'll have a presentation by the authors of the paper, Michelle Arnold, the policy manager here at SCP, and Sav Sian, who's a fellow with us and does part-time work and research every now and then, but he does other things as well. But we're really happy to have them. They'll present the paper. And then we'll have an animated, moderated discussion, also with Sean Campbell from Union Cooperative. Again, someone who's doing great work in the community in this space. But I will now turn it over to Honori Roy, editor at the local magazine, who will be moderating the rest of the afternoon.
Thank you so much, Matthew. It's a pleasure to be here. And thank you to our audience members, all 160 of you. It's an incredible turnout. I'm going to hand it off to the authors of the paper, Michelle Arnold, policy manager at Social Capital Partners, and Sav Sayan, a fellow at Social Capital Partners, to do a presentation on the findings of the report before we start our Q&A. Go ahead, folks.
All right, next slide. Next slide. Next slide. All right, I'm Michelle. I'll just start. This will be quite quick. I think I don't have to convince a lot of people here that affordable housing is really important. What I do want to talk about is that luckily, affordable housing is also a very stable asset class. It's not without risk, nothing is, but the rate of late payments and insolvency is remarkably low and demand is very steady. Next slide. And yet, programs that are designed to support and grow the sector don't always feel like they acknowledge this. It can often seem like program design weights the potential risks disproportionately and at the expense of impact. This is understandable. It's deeply important to protect public assets and investment and to make sure that any support is connected with commitments around long-term affordability. But if we as a country are going to meet the goals that we've set and see Build Canada homes committing to the kind of deals they're working towards, we really just can't accept the various risk mitigation strategies as standard practice. We have to think about them a lot and sort of reflect on whether they work and how they can evolve. So that's sort of the impetus for this work. We identified 3 areas that we think warrant a bit more attention in terms of some of the technical risk mitigation strategies that can encumber nonprofit housing providers. But we also know these are only the tip of the iceberg. So we started here, but we're hoping this sort of catalyzes a larger conversation around the whole series of constraints. Next slide. Next slide. So the first one I'm going to talk about is grants provided as forgivable loans. The structure is very understandable. It allows governments to protect affordability through a very long-term period. But the issue is that it can also immobilize asset value. A nonprofit may hold the legal title, but they have a loan on their books, so they cannot leverage the full value of that asset to unlock the capital they might need to purchase more buildings or improve their current stock. And then the government is obviously also not leveraging the value of that asset. So we have an asset that has value that cannot be leveraged by any of the parties involved in service of greater impact. Slide 4. I will say that there are some instances where forgivable loans are the right move. They're not a tool that we want to take out of the toolbox completely, but we want to think really carefully about when we use them. And in instances where you have a really stable and trusted partner who might be in a position to increase their impact, they can really present a challenge. We think there are a couple of ways to address this issue. First and foremost, you could just provide the grants as grants and use covenants to secure affordability of the property. This can be complicated. There are lots of different ways to do this, and provincial and municipal law play a role here in terms of how you can structure these covenants, but they are possible, and there's ways to think creatively about how to do it. And then where covenants are not possible, we think there may be opportunities for governments or foundations to step in and provide guarantees that allow these stable, strong providers to access financing. Given the sector's relatively low level of risk, it can be a really good way to use balance sheets to unlock financing for the greater good of society. And so now I will pass it over to Sav to talk about the next 2.
Awesome. Thank you, Michelle. And thanks again, everybody, for having us here. We're excited to be presenting this and on the panel that's coming up. So if we can go to the next slide, I'll walk through the beginning of this process here. So governments have engaged in What's a wonderful exercise of leasing land that it owns to nonprofits to build affordable housing. And these leases are often about 49 to 99-year lease terms, and they're for a small or nominal cost. And this, for the most part, is a really good thing because it provides what is typically the most difficult piece as part of real estate development, the land to actually build on. However, the consequence of this is that the leaseholds themselves limit the ability to leverage land value for further equity. Because of the structure of a lease, the value of the land is never transferred to the nonprofits, even though they take on the risk and responsibility of building the actual site that sits on the land. The land underneath the building they built and own is still owned by the government, the city, province, or federally, and that value never translates to the balance sheet of a nonprofit. In the next slide, we can walk through, or sorry, we'll see on this slide actually, there are three consequences to this. The first is how CMHC and maybe Build Canada Homes typically views grant funding for affordable housing. They provide a percentage of the development cost in grants. So the higher the development cost, the higher the grant percentage. Now, because the value of the leasehold is not considered as part of the development cost, it means that grant funding is materially reduced. And this is more of a mechanical issue in how grants are calculated when CMHC funded affordable housing projects, but it means we're effectively undervaluing the cost of development that the federal government, whether it's CMHC or potentially Build Canada Homes, would be funding. The second consequence is that because this land is not owned by the nonprofit, they wouldn't be able to leverage its value now or at any point in the 49 or 99-year lease term. It becomes much harder to seek refinancing or work with lenders when the land is not owned. And finally, and the third consequence, as a landlord, you want ownership of the complete asset, building and land, so that you can make improvements, updates to surroundings, and just have the general latitude needed to meet tenant concerns. And ownership of the building, but not the land, can hinder housing providers' ability to have that latitude needed to make efficient decisions. In the next slide, we'll walk through some of these solutions then. And the solution here is really to pass along some form of title to the nonprofit, while still ensuring that the land is utilized to support affordable housing. And there are a few different technical mechanisms to do that. Number one, you can allow nonprofits to recognize the value of the land on their balance sheet and assure the government that it will be used for affordable housing by establishing covenants on the use of land and building, working with the right lenders to establish a tri-party agreement that can allow this land to be refinanced, while also ensuring it remains for the public benefit. In any private sector development project, land is treated as a highly valuable asset. And this solution is just one that poses a way to tap into that value so that more capital can be extracted and utilized. Secondly, there's arrangements where we can seek out carve-outs to the Housing Services Act, which allow for the province to amend rules related to accounting for nonprofit assets, have leases be capitalized on nonprofit balance sheets, and this would help improve the equity that nonprofits have. And coinciding with the earlier point, working with the right parties to seek out the right financing opportunities to leverage that value, to draw further capital into an environment that's seeking it. And lastly, you can mechanically unlock grant funding from CMHC. As described earlier, even when land is on a leasehold, that value should be recognized as part of the development cost. And the grant funding as a percentage of that value should be maximized as a result. In the next slide, we'll talk through a bit more of a technical aspect on depreciation versus capital reserve requirements. So under the Housing Services Act, nonprofits require an annual contribution to capital reserves for major repairs, which is smart and prudent. It, in effect, forces organizations to have a set-aside amount of cash for eventual repairs to their building. However, at the same time, nonprofits are also required to record the general wear and tear or obsolescence of a building. It's via an accounting principle called depreciation. And both the contribution to the capital reserves and depreciation are treated as operating expenses. And these two requirements get at the same problem. In the accounting world, depreciation says you need to record the cost of the general wear and tear of a building. And the housing operations world, capital reserve contributions say you need to record the cost of setting aside money to eventually repair the building. They get at the same problem. And with razor-thin margins, Forcing additional costs create difficulties. They reduce financial flexibility and places pressure on operating statements. So a potential solution here would be to have capital reserve contributions designated as the primary avenue for the obsolescence of an asset and depreciation only recorded to the extent that reserves fall below the benchmark. In the next slide, we kind of detail this out a little bit more. That essentially tries to factor in an equation or at least a framework that limits the amount of operating expenses that a provider would take on when dealing with these capital requirements of maintaining these buildings. Okay. In conclusion, we can go to the next slide. We are excited and optimistic about the path forward. There's a renewed focus on affordable housing, and by optimizing grant structures, leasehold interests, aligning accounting rules with operational realities, the public sector can unlock more capital in an environment where it needs the most. And these are just a few solutions, but they scratch the surface of what's possible. And we at Social Capital Partners encourage you to read our paper, read through it, read the appendix, because we list out additional topics for further research to help crystallize a variety of outcomes. We can get into the substance of this and more into our next discussion with our moderator, Nori, who's going to kick off the panel now.
Thank you so much, Michelle and Sav, for walking us through these vital findings. Part of what I love about these findings is that they're very tangible, very solutions-based. That also makes them technical and complicated. So it's great to have a panel of experts who can speak to the nuances and the details and break it down for our audience. Before we go any further, I want to introduce our final panelist, Sean Campbell, Executive Director at Union Cooperative. Welcome, Sean. And a reminder to our audience that we'll have an audience Q&A at the end of the session, so please continue to add your questions to the Q&A chat and we'll get to them in due time. Now, Sean, I'll start with you. I'd love to be able to bring this conversation from big technical ideas to tangible experience. Can you tell us a little bit about examples of financing challenges that you've faced as a not-for-profit housing provider?
So we're really quite new. We started back in 2021, and we've tried most things that we could try to finance affordable housing. So we raised money from community members and charitable foundations to acquire existing buildings because there wasn't a government program to do that. And we ran into challenges because, it was great we raised all this money, but then we didn't have a lot of collateral or guarantees to support the mortgage. So we eventually were able to work through that, but it was a challenging process. We're now really fortunate that we are receiving 3 different parcels of donated land from our area municipalities, 1 from one city, 2 from another city, in order to build about 285 new apartments across these 3 sites. Really wonderful. And with that, we're experiencing a lot of what's being talked about here. So with this donated land, there'll be a right of first refusal for the municipality to repurchase it, but it means that we can't encumber the land with any additional secured debt. We can't use that land as a guarantee to support mortgages for other sites. So, for one of our developments, one that will be starting this summer, we're really excited about that development. We received approval from CMHC, which we're really grateful for, but we also needed a corporate guarantee. They said, it's great that you have this site, you have free land from the municipality, you even have grant funding in addition, but we need an unlimited guarantee to support your project. Now, we're really fortunate that our developer was able to step in and provide that corporate guarantee in exchange for a fairly substantial cost. But we are happy we were able to pay that cost in order for the project to move forward. Looking at these donated parcels of land, we won't be able to leverage that land as a guarantee for future projects. So we're going to be continuing kind of in this cycle until we can try and find some more private sector land or foundation guarantees in order to fill in that gap. Despite us having this asset, we won't be able to use it.
Fascinating. And Michelle, Sav, Sean, as we go through our questions, if anything jumps out to you and you want to get in on responding to questions, please feel free to do so. Turning to Sav, can you tell us about some of the challenges that are associated with building or operating housing on municipally owned land?
Yeah, and I want to start off by saying I think the solution of at least being able to build on municipally owned land is fantastic. Like it's working well. I think there are three pieces though that perhaps we could just highlight to improve the process. The first is, as we discussed in the presentation, when you don't own the land, you don't have full latitude to develop on the land and upgrade it over time in its tenancy and in the leasehold to really make it that effective, the best case community for the environment you're trying to build for. I think that's one. Two is, as Sean mentioned in his answer earlier, too, is when you don't own the land, you can't ever factor it into financing possibilities, right? So land is such a valuable part of any real estate development. Any lender looks at land as an asset. It's an asset that doesn't amortize. It's an asset that sort of keeps its value even on, very conservative balance sheets. And that asset seemingly through these leaseholds is untapped. So I think that arrangement, whether it's even nonprofits, we argue for that here. We're advocating for nonprofits trying to leverage that land value and the challenge with operating or building on municipally owned land is that it doesn't do that. But even if the municipality were to take steps in their direction to unlock capital there, like there's a large asset base that's sitting largely untapped. That's a second arrangement there. And the third would be just the question of what happens at the end of this 49-year lease term or 99-year lease term. The building has been constructed, construction financing has been taken out, the cost of building this housing site, the cost of running it and operating it has been taken on by a nonprofit for 50 years or close to 100 years. The expectation is going to renew indefinitely, which is fantastic. And the logical takeaway is if that's the expectation, then why not try to transfer the ownership where you can unlock this next step? And but if that's not the expectation, then I guess what happens at that point is the land leased to another party? What happens when the building's owned by a separate party and the land's owned by somebody else? And these are questions that I don't have an answer for. But at some point, 50 years from now, somebody will have to deal with that, or 100 years from now, somebody will have to deal with that. I think those are the three things that I would look at in trying to improve this process.
And Michelle, can you provide us with some examples of innovations or experiments that you've really seen working with government on housing?
Yeah, I mean, there's so much happening all over the world that's exciting to see. I think that what they're doing with the BC Rental Protection Fund out west is quite a good example where instead of the forgivable loans, it's sort of capital contributions to nonprofit housing providers to buy existing housing stock. That's been really intentional as an effort to ensure affordability through legal agreements versus this kind of forgivable loan. So we can see that in Canada it is happening and it is working so far. Internationally, there's lots of different models. One that I think is kind of interesting. In the UK, they have what they call a recycled capital grant fund. And so they'll give a capital grant to an affordable housing provider, and that provider essentially it's money that they have, but they have to kind of ring fence it such that if they either sell the asset or the use changes, they have a specific period of time in which to recycle that money into affordable housing. And if they cannot find a way to recycle that money into affordable housing, then they do have to repay it with interest. And so it's sort of a different mechanism, but it's a little bit better for accessing financing because it gives them the flexibility to sort of find other places to use it. And the UK has actually also paired this with some sector-led advocacy around the depreciation issue that Sav spoke about, where they are sort of addressing this double counting issue. So those two things together have meant that they're just a bit more able to access the capital they need to expand, which I think is interesting to see. And then I think also other countries have a lot of different guarantee structures, whether they're sector-led or guarantee-led, to sort of pool resources of the sector and use that to support more building. Of course, like every country is quite different and the sectors are different, but I do think there is really fascinating stuff happening in other countries that we could learn from.
Michelle, I'm curious as a follow-up to that, are there Any challenges in being able to import some of those points of inspiration into a Canadian model? Are there things that we'd like to be doing to model on other countries, but that we would face additional challenges on in Canada?
So many. No, I mean, I think just like the structure of how our government works does make it quite difficult. Like the sort of the powers and access to capital and decision making that our municipalities and provinces have relative to the federal government, I think is quite unique, especially when we compare it to a lot of the European countries. So it can be difficult to kind of port some of these things over. I think our housing sector is also like we are a large country and it is quite spread out and yeah, that can be a little bit harder to coordinate. It doesn't mean it's not possible, but yeah, I do think especially there's so much that can happen at the municipal level, but Canadian municipalities are like, I think, quite distinct when compared to European counterparts in terms of what they are allowed to do and have the freedom and flexibility to do. So something to definitely consider.
And is there a particular, if you had to forefront one solution as the sort of first place to go in terms of improving the kinds of challenges we face in Canada, is there something you'd really want to emphasize? Is the point, it should be the point of focus?
I think the forgivable loan piece is, and I think I could imagine someone at a municipality disagreeing with me, but I think that there's just so many examples of how else to ensure accountability. And in my mind, I think a lot of these things remain because they're how it's always been done and because risks have been taken in the past and there have been consequences to those risks. And so we just keep on doing it in like the least risky way possible, which I totally understand. I was also a public servant for quite a while, but I also think like we're not operating in a risk-free environment. Like there are risks in trying to solve big problems. And to me, the forgivable loan piece seems to be sort of a relic of trying to eliminate risk and really should go. Having said that, there are circumstances where it makes sense, but I think like as a fallback, it needs to be eliminated.
Amazing, thank you. And Sean, I had a question for you. As a relatively new organization, are there any points of inspiration that you look to help be able to inspire the work that you do?
There's some great organizations like Wood Green and Indwell. They're just working at a very different scale than the rest of us that we can learn a lot from. I think also we're at just a time where everyone's trying to experiment. And the Housing Accelerator Fund from the federal government has been really important for pushing municipalities of moving quickly because they know that they have hard funding deadlines and being really creative in different ways. At the same point, outside of Toronto, we have lower tier municipalities being asked for the first time to get involved in housing in a way that they never have in the past. In areas like Waterloo Region, where we have a senior tier, historically it's been the region of Waterloo that's been in charge of housing, but now it's the cities that are in charge of disposing their land assets, of receiving half funding. So, that's been good and bad. It's good in the sense that we get to bring new ideas to folks who aren't entrenched in certain ways of doing business. It's also just been challenging. So I think, respecting how hard of a position it's put some of these municipalities in to try and figure out what is the best way to do this, learning from others so that they're not creating undue public risk when they're giving away public land and dollars to nonprofits like ours is tricky. So I think having more guidance from the province and from CMHC or Build Canada Homes to say this is a best practice for a smaller municipality that's doing this work. What is good public governance that you can stand behind while also making sure that we're going back to asking that question of, why are we putting these different asset locks or revenue locks in? Well, it's protect the public good. We know we want to build affordable housing, but if we're giving away public land, if we're giving away cash, we want to make sure that they're maintaining their commitment to affordability long term. So is there a different way to do that? Perhaps we're looking at mortgage defaults longer terms with Build Canada Homes, where, I'm not going to break my covenant with Build Canada Homes because then I'm in full default on my mortgage. The municipality agreement is almost irrelevant when compared with the strength of that. Is there a way that governments can work together in that way to be more impactful? Is there a way that we're looking at repayment of any kind of ill-gotten gains if we're overcharging with interest or penalty, as opposed to applying this to the underlying asset itself? But going back to those first principles of why are we doing this? Well, it's for really good reasons. They're trying to protect the public good, but we're trying to advance the public good as well by creating that housing. There's a tension between those two pieces, and I think we need to make things a little bit easier for municipalities, especially for staff folks who just aren't really this isn't their full-time job. They're working on other parts of urban planning, of social policy. They're being asked to do this for the first time. The other piece I would add too is that as a sector, we need to try and come up with creative ways to grow that don't just rely on government funding. So we're working with a few private sector developers, and I'm hopeful that we'll have one or two developments on private sector land that won't be encumbered. And then so what that's essentially going to let us do is subsidize our growth using private sector land when we can't do that with public sector. So it's unfortunate that we have all these land assets we ultimately can't really use to help our growth. But let's get creative as a sector to try and break out of that box that we're currently in.
You've all touched on this to some degree, but the best way to be able to embrace the challenges and the innovations of the solutions in front of us are to also understand risks comprehensively. We've heard about the way these changes could help create a paradigm shift in nonprofit housing. But are there any particular risks around moving forward with some of these changes? And I'll start with you, Sav.
Yeah, I think the biggest risk, and we heard this in the consultations with our community partners and public policy leaders when we were deriving and delivering this paper. The biggest risk is just when you're asking the government to effectively, it's government-owned land, and leverage that for community financing, community development, affordable housing development. The implicit risk in that is what happens when is that government relinquishing control of that land? And how do you mitigate that? The risk, of course, is that if this was between government and private sector, particularly, there'd be an arrangement where in that contract, it's implicitly understood that if covenants were to fail, if there'd be a breach of contract in some way, and that ownership of that land was transferred to some private sector party, that would be then utilized in the private market. And at that point, that land, that asset would not be held for public good. And that's implicitly understood when you're arranging in contracts between those parties and between those sectors. But the risk is like, how do you ensure that doesn't happen in a nonprofit or as it remains in the public sector? And I think the biggest way to mitigate that risk is just by working with the right lenders. There's credit unions, there's community finance organizations, there's a variety of groups here that are comfortable with deploying capital to housing assets in a way that we also understand that if any breach of this contract were to take place or covenants were to be not met in some arrangement, that the value of that land or the value of the assets wouldn't be sold to the highest bidder, but they'd remain as part of this pool that's going to be used for affordable housing development and community development. But the risk is finding that right balance. It's working with the right people. It's looking to get government involved as well to say that the reward far outweighs the potential of the risk. You need the right legal teams involved to structure the contract. You need a lot of stakeholders involved to just help put the right pieces together. But I would think that's the largest risk that I've seen so far. The second smaller risk, it's a general takeaway on the environment that we're at right now. Um, Particularly, this is I know housing in Canada is so many different areas, but particularly in Toronto, we're at a point now where rental is looked at as probably the more favorable outcome that private developers are going to be building towards in the next number of years. I think historically, housing was primarily built through condos in the last little while. It was driven by investor returns and investor demand. And that's taken a different approach now. The market's reacted slightly differently. So you have an opportunity to build rental housing. You have an opportunity to build purpose-built rentals. That's going to need some element of affordability. It's the closest tie-in that we have now to build more affordable housing, driven by the market than I've seen so far. So this is an opportunity. And the risk there is just that we don't really move quick enough to meet that.
Michelle, anything to add to that?
No, that was a very comprehensive answer. I think I just maybe what I say is like there is a risk that you give money to a nonprofit housing provider and somehow that provider, the board changes over, their values change, they go out of business. Like it is a risk and it's something to consider. I think though, in conversations that we've had, the likelihood of that risk is considered to be so high. And when we talk to people who have actually financed in this space, they say there are so many good, solid nonprofit housing providers. Like it's about doing your due diligence on the partners that you work with. And I think on the other side, it's about building the capacity of the sector to be increasingly capable and sophisticated and strong. And so I think the way to mitigate the potential that you could have a values misalignment and lose affordable housing is to just be constantly also building up the capacity of that sector and just doing the due diligence that you would do on any deal in this space.
And Sean, are there any particular risks that you wanted to speak to?
I think there's the obvious social risk of, continuing to harm people through the lack of affordable housing. But I also think there's the risk to the nonprofit sector of keeping us too small. We need to get to the scale where we can have experts on our teams with the capacity to deal with big projects. We need to get to the scale where when eventually we return to the 90s and no one's building anything because there's no federal funding, that we can go out and get private sector capital in order to try and grow and keep affordable housing developing. We can't do that if we're all operating 100 units or 200. We need to get to a larger scale. And obviously there are challenges that come with scale as well. And that's not the solution to everything. That's one way of looking at it. I think there's also in exercising their due diligence, municipalities and governments sometimes create a lot of challenges for nonprofits as well. So, one of our properties, I think we have 3 different definitions of what affordability is that we have to apply, and they all have to apply. So it's really whichever one is the lowest rent that wins. That's what we have to keep it at. We have different reporting standards, even to the same municipality, one for their grant, one for their land, and it's information that we have to submit to them in to be defined formats that they'll then review, which is ultimately subject to municipal freedom of information requests that could ultimately expose tenant information if you're creative enough. So there are challenges there too. Instead, could we just have our accountant or our lawyer sign an attestation and say, yep, I've looked at the information. I'm not going to risk my CPA designation. They are actually renting it out at the rates that they said they would. That would seem to be a reasonable approach as well. So how do we make this simpler across the board? Still recognizing the important oversight that governments have to have, but trying to de-risk that in the process. We're also seeing some interesting challenges around community bonds and community finance, where governments are not accepting that behind the mortgages that they're providing. So even as we're looking at other creative ways to bring capital in, governments are seeing that as too risky. In part because of the way these financing arrangements are structured, they're at the bottom of the pyramid. So, the community folks who are doing their best to support projects will be repaid last if there's anything that goes wrong as well. So again, creating risks in the system that make things a bit harder. The one piece I'll end with is just faith organizations are getting really creative, and they also own land. They've had for a long time. Their boards or trustees or governors are trying to make decisions that are in the best interest of their faith organization and having to engage their broader community too. So micro municipalities in a way. And one of the things that they're looking at is almost a joint ownership of, can we create a new nonprofit where Union Co-op will be one member, will take care of the day-to-day operations, but they'll have a membership as well that has to approve any fundamental changes. If we try and sell the land or increase the rent, we need their approval as well. That doesn't impact our mortgage financing because it's at a corporate governance level, not at a property level. So what are these other tools that we might be able to use that still ensures that we advance that social purpose, but we're not taking away from our growth?
Fascinating stuff. And I think part of what's been so interesting about this discussion is that it sounds like there are a lot of ideas, and part of what we need is to be able to translate them into political interest and will and momentum. I'm curious about, when you're trying to translate all of this to the public, as part of my job is to be able to look in on issues from the outside and then be able to translate them to audiences who may not know very much about them. I'm curious about, are there any particular ways that break things down, break these technical ideas down into easy concepts so that you can drum up interest or excitement amongst the public, or make it easier for people outside of the sector to understand what you're talking about? It's a question for all of you.
Maybe I can start with just trying to take a stab at that. I think what's helped for me, Inori, is talking to people about these topics, like really just engaging with your environment and talking to people who have a different academic, professional, lived experience than you. You're forced to get out of your own bubble and jargon and way of defining these terms and thinking of them, and explain them in a way that makes both operational sense, you know, is simple in terms and simple in language. And then also because you're speaking with somebody that has, again, these different viewpoints, different experiences, they add so much more to that conversation, and it really helps even crystallize your own understanding. And then ideally, maybe you land on a simple way to communicate something that can get mass appeal, right? But I know Michelle and I worked on this paper together, and a lot of that was like us working back and forth at what makes sense and how do we kind of explain some of these technical terms into a bit more of a ubiquitous way to understand that's palatable for anybody. There's no science behind it, but I just think really it's a kind of a cop-out answer, but it's a truth. Interact with your environment, and you add so much more to it.
Maybe I'd add one thing, which is something that I found compelling in learning about this, is just that it's not like there's only risk associated with doing deals or funding to nonprofit developers. Like there is lots of risk that is taken on when government works with the private sector, and trying to sort of highlight that that is not a reason not to do something. It is just something to consider mitigating in the process of trying to achieve whatever public policy objectives you are going for. I at least have been like, oh yeah, of course that makes sense, that there's always risk.
Amazing. And a lightning round. I'm curious about what gives each of you hope as we wrap up this discussion. What makes you excited for the future, and what gives you hope for the sector as a whole?
I can just start because I'm not really like in the sector, and I've learned so much about it recently. It's just like how much capacity and creativity there is. Like people are doing really amazing things, and they're taking financial instruments and turning them on their head. And I just like I can't believe how much like creativity is going into thinking about how to make all of this stuff work. I feel like in particular, Sean has told me all sorts of stories where I'm like, wow, that's such a good idea. Not to put you on the spot. There's just like a lot of really cool stuff happening.
I love working with you, Michelle, because I can just tell you fun ideas and then you can go do interesting stuff with them after. Um, I think it's so exciting just how many people across the country are working on this and getting really creative. We're at a period where, as Michelle mentioned, people are trying to break the rules. That's the wrong way of saying it. Trying to reinvent the system so that we work well within the rules in order to help people. And I think that's really inspiring. And so in Waterloo region, in our area and the surrounding areas, we're trying to build 1,000 community-owned homes by 2031 as a fairly new housing organization. That's a drop in the bucket, but we know that there's groups like ours all across the country that are working just as hard, and that's important. I think it's also interesting to see how we can build relationships across sectors as well. We know that in the conservation land trust space, the province has a really clear tool for how to ensure long-term conservation rights are met with a special easement that then is matched by the government of Canada through the CRA of eco gifts tax credit. We don't have any of that on the affordability side. So how do we also make these processes simpler and stop, having to get fancy legal contracts that do all this work, and just come up with simpler approaches to do this as well? So hopefully if we all keep going back to first principles when we're having these conversations to say, well, why are we doing this? Is to make sure that if Sean says he's going to maintain affordability, that he will, and the organization will when he's gone. All right, what's the simplest way to do that to ensure public trust while also allowing growth? I'm excited for those conversations to continue to happen, in addition to all the more kind of interesting technical stuff as well.
What gives me hope, honestly, is that real estate as an asset class and as a sector here in Canada, particularly in Toronto, is a high value one. I think worldwide, it's maybe the most valuable asset class. You have a shortage of housing that's required here. So then there's different sectors that can tap into the capital that so many have already. And so I think there's just hope because there's so much potential. High value asset class. Everyone needs a home. We understand that there's a bunch of parties and ways to get involved in this sector. So I just think there's only upside.
Incredible. I think you guys are building a lot of excitement and a lot of creativity among our audience members who I can see have many, many questions. Richard, why don't I pass it over to you to be able to facilitate some audience questions to our panel of experts?
Sure. Thanks, Sonori. Yeah, no, this is, I mean, if I were to answer that optimism question, it'd be that we're even having this conversation is I think highly optimistic. This is a brilliant insight into what could be. So I'm thrilled that we're giving platform to these ideas, and we'll definitely want to come back to them over time. One housekeeping question: will the deck be available to our audience? Can I get a nod? I'm assuming yes. Yes, so we'll send that. I don't know. I assume that the report link has been made available to everybody from our marketing from the beginning, but maybe if one of you or one of our staff puts the report link as well into the chat, but that I think is available on our website as well and yours as well, and we'll make sure we give people that. A number of questions here are kind of technical or policy nuancy, and I'm not the best person to relay them, but if the audience can help me out, if there's some questions you want to vote up, use that thumbs up button on the question, and I'll try to start dealing with the ones that get the biggest votes up first. But I'll start with one here. It seems like transferring ownership to the nonprofits would kill several birds with one stone. But do you think it's an equally viable approach to make other changes, e.g., to the Housing Services Act or other legislation, and continue with a lease arrangement? Who wants to take that one?
Yeah, I can take the first stab at that. I I think Sean may have a comment as well. But the ownership piece, I think, is just the easiest that way to move things forward. That's just the best mechanism. Housing Services Act is viable. I wouldn't say it's equally viable, just because it probably requires a little bit more work and definition in terms of you're changing a provincial arrangement, and it's not unclear then if that is going to have the fully intended downstream impacts to the city and upstream impacts to the federal government in the way that just completely like ownership transfer would. Um, Sean, Michelle, feel free to jump on in, of course, if there's anything that you wanted to add to that.
No, nothing else. I think you're exactly right. It's ownership of land.
The only thing I'll add in is that like there is like a philosophical debate about the degree to which the public sector should own assets versus give them away. And I don't have a strong opinion on what that right ratio is, but I think what we're seeing now is that there are effective transfers of ownership without also providing the resources that the nonprofits need to actually succeed. And that seems like the worst of both worlds to me.
I'll ask one more question, then I'll go to the votes. As someone who'll be developing land strategies for various municipalities across Ontario, is there any language or key policies that could be included in the strategy that could help create an environment where nonprofits could leverage their assets? I think you've spoken to that, but maybe someone wants to punctuate an answer to that. I'm not good at pointing it. Just go ahead, Steph.
Sure. I'm not sure if this person is acting as in for the municipality or from the
Sounds like it.
nonprofit, but if the intention is to have the nonprofit be able to own or leverage that land value, there is something called a bargain purchase option at the end of a lease term, where at the end of a lease term, if you have you have an option to like purchase this asset for what's considered to be potentially like a bargain. I think that would help allow that asset to be on the lessee's balance sheet. It's a bit of a technical arrangement, but it's something maybe that's worth considering. That needs to be looked at from a variety of areas, of course, but just purely thinking about it from the vantage point of capitalizing an asset at the end of a lease term, that's perhaps something that could be of use.
Okay, the next question, the highest number of votes here, 7, from Keisha Wallace. I feel like you've addressed this, but it's being asked, so maybe again punctuating an answer here, and I'm going to read the second question as well, so you can answer either. Keisha asked, one of the biggest challenges mentioned was that nonprofits operating on municipally owned land cannot fully leverage the land as collateral or equity. In your opinion, what financing or policy change would have the biggest impact to helping nonprofits scale beyond one-off projects into sustainable housing portfolios? I feel like you've addressed that, but maybe you could punctuate because it is getting a lot of votes. But again, the next question is, considering underutilized and vacant buildings and brownfields for reuse and redevelopment for affordable housing, and what are the challenges? That gets the next level of votes. Who wants to take that one? The first one, I feel like you've addressed it, but maybe again underscore.
Sure. I'll take a quick stab at just the first part, and then open it to Michelle and Sean for the remaining as well, and to add on to what I'm saying. The best way, really, if you think about it, is you want to have assets that you can then recycle capital against. And there's assets that you have that you can recycle capital, either your building or the land. So in an arrangement where that land is owned by a nonprofit, if you work with the right lenders, work with the right community finance parties, there's organizations that are willing to provide capital to a nonprofit, and they can sustain that source. And then now they have a set of capital based off of the value of the building and based off the value of that land. And a lender's comfortable providing this now more because land is part of that equation. That gives you just a set aside amount of capital you have to deploy on future projects, other projects. Then you have scale. And then as you have scale, now you're generating actually some effective net operating income. And as you have a lot of that, you can now deploy that capital elsewhere. So it's kind of like a little bit of a domino effect. But the intention, at least to start, is you need assets to build that base off of.
That's great. These questions are so related. So if you think of, we find a brownfield site in our community that we want to develop on, and I want to buy it. There's no government funding to buy vacant land to develop on, so I need to raise money. I go to charitable foundations and high net worth folks because I know that they can bring the money quicker than I could get from a community bond. They are comfortable securing it to this property. That's great, but I actually need to then get a bank mortgage and additional capital in order to actually remediate the site, because there's no money out there to pay for site remediation in terms of affordable housing loan capital. I need to get all the site planning approvals in place and do the actual to prepare for development. That's a big amount of money. And all of a sudden, the amount of loans that I've received as a nonprofit, because I can only bring in money as debt, is greater than the value of the property itself. So ideally, I'm securing it to an additional property that has strong cash flow, and I can start paying that interest back right away rather than accrue it, or else I'm creating more risk for the lender, for my charitable foundation friends. But that's tough because my existing properties have municipal covenants that say I can't add any more debt to them. So what I then try and convince the foundations is we'll do that on an unsecured basis, and trust me that I'm good for it, that I have cash flow coming from these other properties. You just can't secure it. So in the event that I break my word or something bad happens, you don't have any recourse. But assuming everything's good, I do actually have this cash flow. So then instead, you start seeing nonprofits creating community bond campaigns or third-party investment funds as a way of raising unsecured debt or even equity based on these assets that they can't otherwise access. So we have these two challenges together. There's no government funding to acquire land prepared for development. We have to bring shovel-ready projects that can be built within 6 to 12 months. But then we can't actually access the capital to do it. So thankfully, there are some incredible foundations, incredible developers, and community financing solutions like bonds and others that are working. But holy cow, it's a lot more work and a lot more risk than if we had a simpler solution.
Yeah, I'll just jump in really quickly. I'm basically echoing what they're saying, but it seems like there's two elements where something like the BC Rental Protection Fund, you're allowing nonprofits to own more assets that they just own outright, and that gives them more leverage that they can use on one hand. And then I think that there's really some need for government to create or facilitate a larger guarantee or insurance structure to support the growth as well. So they come on both ends.
Okay. All right. I'm going to ask one more question. Pedro Barada from Habitat Humanity Canada said this innovation is much needed and this kind of work can help shine the light on where we need to go. Thank you. But it's a major change for nonprofit developers. And my guess is scale is probably a long ways off. Given where we stand now, what would be the best scenario for timelines around when this kind of approach would be ready for adoption across the non-market ecosystem? So that's a very big question that needs very short answer. I don't know if Matthew, if you want to come back in on this at all as well, but let me throw that out to you because obviously pressing against that question is this is the moment. Waiting too long and we're squandering an opportunity when some things are cheaper. But who wants to drop that question? Matthew, I saw you went off mute, so why don't you take us home on this final question?
I will. I'll turn it over to others. I'll just say briefly, because I don't have an answer for Pedro as much as I would like. But to pick up on a couple of other themes, what gives me hope or optimism or encouragement, I really do think that there has been a change over the last number of years about the problem definition, which creates policy windows and windows of opportunity. And we are at a time when governments and communities and investors are experimenting with all kinds of new mechanisms and approaches. And there is a broad recognition that what we are doing has not been working for some of the issues we care about. And we have a whole bunch of legacy programs, legacy systems, legacy rules. And so the optimism that Pedro sees, like we're having this conversation, I do think creates a real opportunity for people to go to government with tangible solutions and organize and mobilize. Governments want solutions. They really do. But their systems don't easily generate them quickly. So that's my comment. We know lots of people who are looking to build larger funds that can do the due diligence for larger investors. So larger investors, institutional investors can't usually invest in small individual projects. But if someone was doing the due diligence on a larger fund and doing the individual investments, you might be able to mobilize more institutional capital for some of this work. But it really comes down to an intentional mindset from governments to change the rules, to reassess what risk looks like and how to achieve the outcomes we're trying to achieve.
I think Matthew did a great job there, and I'm gonna pull it at that point because we always end on time, and that's our commitment to our audience at all times. I want to thank Honori. I want to thank, of course, Matthew for bringing this to us. Sev and Michelle, thank you for producing the report and speaking to it. Sean, brilliant to have your insight as a practitioner in the field in this conversation. It feels to me, in listening to this conversation, I think it's fascinating that really, of all the levers we have to pull in government right now, money is short, but policy with a bit of maybe a risk appetite change is a huge opportunity in a moment that is fleeting. This is not if we have this wait 5 more years for this conversation, the opportunity is diminished significantly. Not just wasted 5 years, but the economics aren't there. But the economics kind of are here right now, and this is hopefully going to pick up a lot of traction. So congratulations to you, Social Capital Partners, for doing this work. You've generated a lot of excitement, huge audience for this today. So thank you, and wish you all a great week. See you soon.
Thanks, everyone.